It was the perfect trap. And if you looked at your portfolio on Friday afternoon, you might have walked right into it. Silver closed the week at 89.94, down nearly 2.5% on the day, down almost 7% from the recent highs. The headlines were instant and brutal. They told you the rally was over. They told you the Trump trade was dead. They told you that because the president suspended the new tariffs on critical minerals, the supply squeeze was canceled, and it was time to take your profits and go home. They are lying to you. Or, to be more charitable, they're looking at the noise while the smart money is looking at the signal. What happened this week wasn't a market correction. It was a political bear trap. It was a classic sell the news event designed to flush out the weak hands, the tourists, and the leveraged speculators who don't understand what is actually happening beneath the surface. Because while the retail public panic sold their silver on Friday, the biggest whales in the world were doing something very different. They were buying. And they weren't just buying a little. They were buying everything you sold. I want you to ignore the red candle on the chart for a second and look at the flow data. In the last 30 days alone, while the media was screaming about volatility, private investors poured $921.8 million into silver ETFs. This is unprecedented. Analysts are calling it the most crowded commodity trade in history. Do you think these institutions are stupid? Do you think they poured nearly $1 billion into a metal just to sell it because of a temporary tariff delay? No. They know something the algorithm-reading day traders don't. They know that the Trump dip is a gift. They know that while the government is playing games with tariff announcements to manipulate sentiment, the physical reality of the market is screaming shortage. Think of the silver market right now like a beach ball being held underwater. The water is the political headline risk, the tariff delays, the Fed rhetoric, the sell-off narratives. It pushes the price down. It keeps the ball submerged near $90. But the air inside the ball, that is the buying pressure. That is the 169 days of inflows. That is the billions of dollars of institutional capital accumulating position. Every day that the price stays suppressed, the pressure inside that ball grows. The institutions are banking on one thing, that eventually the hand holding the ball down will slip. And when it does, the ball doesn't float to the surface gently. It explodes upwards. We are sitting on a powder keg. The 14-day RSI has reset to neutral. The weak hands are gone. The speculators have been washed out. And now the only people left in this trade are the ones with diamond hands and the ones with inside information. And the reason they are holding so tight is not just about supply and demand. It is because a new, far more dangerous geopolitical conflict just opened up in the Arctic, and it involves a 10% tariff threat that could change the map of the world forever. Let's start with the data point that should be keeping every short seller awake at night. We need to talk about the iShares Silver Trust, SLV. To the average person, this is just a ticker symbol. To a Wall Street algorithm, it is just another liquidity pool. But to anyone paying attention to the plumbing of the financial system, what is happening inside SLV right now is a statistical impossibility. As of this morning, the SLV ETF has recorded 169 consecutive days of net inflows. Let me explain what that means in simple terms. For nearly 6 months, every single trading day without fail, more money has entered the fund than has left it. It doesn't matter if the price of silver was up 5% or down 7%. It doesn't matter if the Fed was hawkish or dovish. It doesn't matter if President Trump was tweeting about tariffs or tweeting about golf. The buying has been relentless. The buying has been algorithmic. The buying has been insensitive to price. They tell you that retail investors are chasing a bubble. The reality is, retail investors panic. Retail investors sell when the chart turns red. We saw that on Friday. The little guy saw the tariff news and hit the sell button. But the inflows didn't stop. That tells you exactly who is on the other side of this trade. This is institutional accumulation. This is the smart money, the sovereign wealth funds, the family offices, the endowment funds, using the volatility to build a position that they plan to hold for the next decade. They are treating silver like a black hole. They are sucking up every available ounce that hits the market. In the last 30 days alone, $921.8 million flowed into silver ETFs. That is nearly $1 billion in a month. To put that in perspective, the entire annual global production of silver is worth roughly $20-25 billion in 1 month. Just the excess investment demand absorbed nearly 5% of the year's total supply. This creates a phenomenon I call the divergence trap. On the surface, the price The signal looks weak. It drops from $93 to $89. But underneath, the volume, the strength is exploding. It is like holding a beach ball underwater. The deeper you push it, the more you use headlines and paper contracts to suppress the price, the more potential energy you build up. The institutions are holding the ball down. They want the price to stay low so they can keep buying. But eventually the physics take over. Eventually the beach ball slips out of their hands. And when 169 days of buying pressure is released all at once, you don't get a rally, you get a vertical line. Now, the mainstream financial media has looked at these inflow numbers and they have coined a phrase. You will see it in Bloomberg. You will see it on CNBC. They're calling silver the most crowded commodity trade ever. When you hear crowded trade, what do you think? You think bubble. You think top. You think of everyone piling into one side of the boat until it tips over. That is exactly what they want you to think. They want you to believe that because everyone is buying, you should be selling. They tell you a crowded trade is a sign of a crash. The reality is, it is only a crash if the crowd is wrong. Let's look at history. Was the iPhone a crowded trade in 2008? Yes, everyone was buying Apple stock. Was Amazon a crowded trade in 2015? Yes, every fund manager owned it. Did they crash? No. They went up another 1,000%. Why? Because the crowd was right. The fundamental shift in the world's smartphones e-commerce was real. The crowd piling into silver right now isn't betting on a meme stock. They aren't betting on a crypto token with a dog on it. They are betting on physics. They are betting on the fact that you cannot build the modern world without this specific element. We are seeing a crowded trade. Because the world has realized that silver is the industrial oxygen of the 21st century. If you cut off the supply, the economy suffocates. So when they say crowded, I say consensus. The consensus among the people who control the capital is that the dollar is failing, the debt is unpayable, and the only way to protect purchasing power is to own the most conductive metal in the periodic table. Do not bet against the consensus when the consensus has $50 trillion in assets. Now, let's peel back the curtain on the specific event that caused the sell-off this week, the Trump dip. On January 16th, President Trump announced he was suspending the planned tariffs on critical minerals. The market read this as, oh, the trade war is over, supply chains will remain open, silver will flow freely. Traders sold, the price dropped. This was a head fake. It was a strategic feint designed to lull the market to sleep before the real punch was thrown. Because the very next day, on January 17th, Trump opened a new front in the resource war that nobody is talking about. He threatened 10% tariffs on imports from 8 European nations, including Germany and the UK, if they do not support a U.S. purchase of Greenland. You might be laughing. Greenland? The ice cube? Why do we care about Greenland? The media treats this like a joke. They treat it like a vanity project, like a real estate mogul trying to buy a really big island. They tell you it's about ego. The reality is, it's about zinc, lead, and silver. You need to understand the geology of the Citronen Fjord in northern Greenland. It is home to one of the world's largest undeveloped deposits of zinc and lead. Why does that matter for silver? Because silver is almost never found alone. Silver is a byproduct metal. Over 70% of the world's silver comes from mining other things, mostly copper, zinc, and lead. You don't dig for silver, you dig for zinc, and you get silver as a bonus. If the United States controls Greenland, they control the Citronen mine. They secure a domestic, or at least territorial, supply of the critical minerals needed for the green energy transition and the war machine. This is not a real estate deal. This is a strategic annexation of resources. Here is why this is bullish for silver no matter what happens. President Trump has given Europe an ultimatum. Help us buy Greenland, or we tariff your exports. Scenario A, Europe refuses. This is the likely outcome. Denmark has already said Greenland is not for sale. The EU will back them up. So, on June 1st, 2026, the tariffs hit. A 10% tariff on European goods is a declaration of a trade war within NATO. It breaks the Western alliance. When alliances break, what happens to safe haven assets? Scenario B, the US takes Greenland. Let's say a deal is made. The US secures the rights to the mines. Now, the U.S. controls a massive choke point of future supply. They will prioritize that silver for American industry, for Tesla, for Lockheed Martin, for NVIDIA. They will restrict exports to China. This creates a bifurcated market. Silver inside the US zone will have one price. Silver outside, in China and Europe, will have a much higher price because they are cut off from the source. This is the end of the global spot price. So, the Trump dip on critical mineral tariffs was just a distraction. The real story is that the US government is aggressively moving to seize physical territory to secure metal supply. You don't try to buy an island for billions of dollars if you think commodities are going to be cheap and plentiful. You buy the island because you know a shortage is coming and you want to own the mine before the panic starts. We have talked about the financials, the ETF flows. We have talked about the geopolitics, Greenland. Now we must talk about the physics, the industrial floor. The competitor mentioned AI data centers and solar, but they glossed over the scale of the problem. They treated it like a bullet point. We need to treat it like a crisis. In 2024, global data center power usage surged by 19%. That is not a growth curve. That is a vertical takeoff. By 2026, we are hitting the energy cliff. The current electrical grid cannot handle the demand of the new AI clusters being built by Microsoft, Amazon, and Google. These aren't just server farms anymore. They are gigawatt campuses. To make these campuses work, you need efficiency. You cannot lose power to heat. You cannot have resistance in the wires. Silver is the most conductive metal on Earth. It is 7% more conductive than copper. In the world of high-performance computing, that 7% is the difference between a chip that works and a chip that melts. This triggers the Jevons paradox. Economists will tell you that as technology gets better, it uses less resources. The reality is the opposite. As technology becomes more efficient, thanks to silver, it becomes cheaper and more useful. So we use more of it. We don't build fewer AI chips because they are efficient. We build millions more because they are profitable. The bears will tell you, oh, if silver gets too expensive, they will just use copper. They tell you substitution is easy. The reality is substitution is suicide. In a solar panel, if you switch from silver paste to copper paste, you lose efficiency. In a 20-year power contract, losing 1% efficiency means losing millions of dollars in revenue. In an AI server, if you switch to copper connectors, you increase heat. Increased heat means more cooling. More cooling means higher electricity bills. The cost of the silver in an iPhone is maybe $1. If silver goes to $100 an ounce, the cost goes to $3. Does Apple care? No. They will raise the price of the phone by $20. They will pay the price. This is called inelastic demand. The industrial buyers are not price sensitive. They are performance sensitive. So, as we enter 2026, we are looking at a fifth consecutive deficit year. We are burning the candle at both ends. We are mining less because grades are falling, and we are consuming more because of AI and solar. The math doesn't work. And when the math doesn't work, the price has to fix it. Now, I want to address the chartists, the technical analysts who are drawing lines on their screens and screaming double top. They are looking at the price action from last week, the failure to break 94. And they are saying the momentum is dead. They are reading the chart upside down. They are missing the most critical signal in technical analysis, the RSI reset. The Relative Strength Index, RSI, measures how hot a stock or commodity is. When silver hit $93 this first time, the RSI was at 85. That is extremely overbought. The engine was overheating. It had to pull back. But look at where we are today. The price is still hovering near $90, within striking distance of the highs, but the RSI has cooled all the way down to 62. Do you understand what that means? It means the engine has cooled down, but the car didn't slow down. This is called a bullish coil, or a time correction. Instead of the price crashing to reset the momentum, the price simply waited. It consolidated. It forced the short-term traders to get bored and sell, while the long-term buyers, the ETF whales, quietly absorbed the supply. This is not a top. This is a refueling stop. The market has successfully worked off the overbought condition without giving back any real gains. Now, the RSI has room to run from 62 back up to 85. And since we are starting from a price of $90, that next leg up doesn't take us to $94. It takes us mathematically to 115. They tell you the chart looks exhausted. The reality is, the chart just finished resting. This brings us to the final mechanism, the one that triggers the vertical phase. We need to talk about $94. Right now, $94 is the Maginot line. It is the resistance level where the sellers have parked their tanks. But what happens when that line breaks? What happens when we get a daily close at 94.50? We enter a zone called Blue Sky Discovery. There's no historical resistance above 94. There are no bag holders from 10 years ago waiting to sell at $96 to get their money back. Everyone who owns silver at $95 is in profit. And people in profit don't panic sell. They hold for the moon. This creates a vacuum effect. When you remove the sellers, the price doesn't just drift up, it gets sucked up. It moves violently to the next psychological level. The first stop is $100, but $100 isn't a wall. It's a magnet. It will pull the price toward it with gravitational force. And once we clear $100, the algorithms change. The unit bias disappears. Institutional models that were programmed to sell at resistance will flip to chase mode. They will realize they are underweight in the only asset class breaking out to all-time highs. This is where the FOMO, fear of missing out, shifts from the retail investor to the portfolio manager. Imagine being a fund manager who owns zero silver while it is the best performing asset of 2026. You get fired for that, so they will panic buy. And when $1 billion fund panic buys into a vacuum with no sellers, that is how you get to $122 by mid-February. We have arrived at the conclusion. We have pulled back the curtain on the political bear trap that snagged thousands of retail investors last Friday. We have analyzed the 169-day inflow streak, proving that while the public was panic selling on tariff headlines, the institutional giants were panic buying nearly $1 billion of metal. We have exposed the Greenland Ultimatum, revealing that the Trump trade isn't dead. It has simply morphed into a high-stakes resource war over the Citronen Fjord mines. And we have done the math on the AI energy cliff, confirming that the 19% surge in power demand makes silver statistically irreplaceable and geologically insufficient. The verdict is stark. The pullback from $93 to $89 wasn't a trend reversal. It was a gift. It was a manufactured liquidity event designed to transfer wealth from the impatient and paper hands to the strategic diamond hands. The market coil has reset. The RSI has cooled. The beach ball is being held underwater with trembling hands. We are not looking at a market top. We are looking at the final consolidation before the blue sky breakout. So, what do you do when the president tweets, the media screams sell, and the price drops? Here's your battle plan for the next 30 days. Step 1. Buy the political dip. Recognize that volatility caused by policy announcements is almost always noise. If the price is below $94, you are still in the accumulation zone. The institutions are buying this dip because they know the tariff suspension is temporary, but the supply deficit is permanent. Follow the smart money, not the loud headlines. Step 2. Watch the $94 breakout. Do not try to time the exact bottom. Watch the resistance. The moment we get a daily close above $94, the vacuum effect begins. If you're waiting for a pullback to $70, you're going to be left on the dock. In a breakout scenario, the most expensive thing you can own is cash while you wait for a dip that never comes. Step 3. Ignore the crowded trade narrative. When the talking heads on CNBC tell you silver is too crowded, remember the iPhone, remember Amazon. Consensus isn't always wrong. Sometimes the crowd is running for the exit because the building is actually on fire. In this case, the building is the fiat currency system and the exit is silver. Be part of that crowd. I want to leave you with this. In every great wealth transfer, there is a moment of maximum deception. It is the moment right before the explosion where the powers that be try one last time to shake you out. They lower the price. They confuse the narrative. They make you doubt your conviction. They want you to hand over your hard assets in exchange for their dying paper. Don't give them the satisfaction. The only thing worse than missing a generational bull market is being in it, understanding it, and then getting scared out of it 3 days before it changes your life. The financial media is paid to keep you confused. They are paid to feed you the news. We are here to show you the signal. If you are tired of being the retail liquidity for the institutional whales, if you want to join the few who understand that the map is not the territory and the price is not the value, then you know what to do. Join us. Subscribe and turn on notifications. Because the next time the beach ball breaks the surface, there won't be any time to argue. Hold your position, watch the flows, and I'll see you on the breakout.